Anything? Right. Good afternoon, everyone. Let's move on to the new topic on international finance, cost of capital for foreign investment. Why we should learn about again the cost of capital of foreign investment? Is this different from cost of capital of domestic firms? What do you think? Huh? Do you think it is same as the cost of capital of domestic firms, higher than or lower than? Because when we go to the international market, companies get a chance of chance to diversify more, right? They can, according to the theory, we know that they can reduce the risk of their investment through diversification, right? If the company is open to the international market, international business, they have that chance of diversification, right? They can locate their businesses in other countries where there is a low risk, where they have good access to all other resources, right? Likewise, they can minimize the risk. So what do you think, whether the cost of capital would be equal to the yeah, it depends. Yeah, it depends. We cannot say anything to finalize, but it depends. Therefore, this is one of the critical question in international finance. What decide the cost of capital of multinational companies, right? Because when they take the decision, their decision is entirely based on the cost of capital. Whether they can achieve their required rate of return, then only they will go for the investment, right? Therefore, company has to identify the project cost of capital when they are going for the international business, right? When they are going to initiate their business, right? Right. So what factors decide the cost of capital of MNC, multinational companies? What are the factors that decide the cost of capital of multinational companies? Affiliation of cash flows. What is that? Affiliation of cash flows. What do you think about the cash flows of multinational companies? We know multinational companies have their subsidiaries in other countries. Parent company is located in somewhere and subsidiaries are there in some other locations, right? Subsidiaries report their cash flows in their currency, right? So what would be the stated value of this cash flow also affect the stated currency of this cash flow is also affecting the cost of capital of multinational company. If that particular currency is highly volatile, highly fluctuating, right, highly devaluating, there is a risk for the company, right? So their cost of capital would be also fluctuating based on the cash flow, based on the currency value, right? Therefore, the cash flows affiliated with the multinational companies is important, is a major issue or major factor that decide the cost of capital. Because when it comes to multinational company, cash flow representing different currencies, right? If the foreign exchange fluctuation is there, that currency also would be fluctuating. That affects ultimately to the cash flow of the company, the parent's company cash flow, right? Correlation between domestic and foreign economy. What is that? Correlation between if the domestic and foreign economy fluctuation is not much, volatility is not that much, there will be no big problem in calculating multinational companies cost of capital, right? If the deviation is very high, if the fluctuation is very high, then we cannot compare the domestic companies cost of capital with the multinational companies cost of capital. Here the main problem is when we calculate the cost of capital for the multinational company, we have to think the company has to maintain the cost of capital of the parent company. Even though that is located in somewhere else, fund has been remitted by the parent company. So the risk should be same as the parent company's expected risk. Their required rate of return based on the risk they face, right? If our risk is different, the cost of capital would also be different, right? So if the domestic and foreign economy changes in the domestic and foreign economy, the fluctuations in the domestic and foreign economy is not much bigger, the gap is not that much, there will be no much impact on cost of capital. Otherwise it will be highly influencing to the cost of capital, right? Correlation between domestic and foreign economy. Cost of equity capital definition, right? In order to calculate the cost of capital, we have to calculate one by one equity, debt capital and all, like we did in the corporate finance, right? We have already done this relating without incorporating the impact of exchange rate. Now our concern here is incorporating the different risk associated with international finance, international business, and calculate the cost of capital incorporating the all the risk factors affecting to the international business, right? Because when we compare the domestic business and international business faces different kind of risk than domestic business. Political risk would be very high, economic fluctuations will be very high in the international business, right? Size of the company would be different, right? So many other factors are affecting. International diversification, exposure to the foreign exchange rate, and some companies in the international market, international business have access to the international capital markets where they can negotiate sometimes their rates with the they can easily find out what is the best rate for their borrowings, right? If they have access to the international market. And as in international business so many companies are involved, it is exposed to the international political risk, right? So that when we calculate the cost of capital, we have to incorporate all those additional risks apart from the cost of capital of the domestic company, right? So the definition, the minimum required rate of return necessary to induce investors to buy or hold the firm stock, right? That is the minimum amount that we have to pay for the investor in order to hold our stock, right? If he is going to buy, so he is expecting some return from the cost of capital used to value future equity cash flow, right? the required rate of return determines the common stock price. To assess this, CAPM can be applied, right? In order to calculate the cost of equity, we use capital asset pricing model, right? When it comes to international finance, we call international capital asset pricing model, where we consider the additional risk factors as well, right? Apart from the risk that we consider in the domestic market, we have to consider the additional risk associated with the international business. Otherwise, that will not be reflecting the right cost of equity capital. Right. This is the normal capital asset pricing model, right? According to CAPM, required return and its associated risk can be shown as RI, that is the required return, equals RF, risk-free rate, beta, right, times RM minus RF. Covariance between return on security I and the market portfolio and variance RM is the variance of returns on the market portfolio. That is the definition for beta, right? Covariance RMRI is the covariance between return on security I in order to calculate the WACC, right? We need to do different adjustments to the CAPM model, right? Using just the same CAPM model, we cannot, because we cannot estimate the right cost of equity capital, because the risk covariance between return on security I and market portfolio and the variance of of return in the market portfolio is different. That is beta, right? Beta is different, because how we calculate the beta? Normally, how the firms calculate the beta? That is the risk, systematic risk, right? Or non-diversifiable risk, right? How we calculate the beta? Based on the experience, right? I'm asking using this equation we calculate it. We calculate the beta based on maybe past data, past market data of a particular country or particular of a particular country, right? That is the systematic risk, which is not possible to diversify. Therefore, when we calculate the cost of equity of multinational company, we have to think of the calculation of beta specifically, because the risk, systematic risk of the domestic company is different from the systematic risk faced by the multinational company, right? That would be higher or lower. We cannot say that, right? It depends, right? So it is actually a problem. It is very difficult to calculate the right risk of the multinational company, I mean systematic risk of the company faced, but still we have to consider actual scenarios and actual data and calculate is as much as accurately, right? Beta risk of foreign projects. Foreign projects in non-synchronous economies should be less. Should be less correlated with domestic markets. What is this non-synchronous economies? Yeah, not occurring together. Yeah, right. That means companies which are not much engaged in international business, less correlated with domestic markets, right? There may be companies, they are not much engaging foreign business, right? So as we said at the beginning, if the correlation between domestic and foreign market is very less, it is easy to estimate the risk, right? Because the correlation is high. If the correlation is high, so it is good. That means gap is very low. If the correlation is less, non-synchronous, we are talking about the non-synchronous synchronized economies, right? If the correlation is less with the domestic markets, then foreign exchange risk calculation would be difficult, right? Multinational companies have greater political risk but offer high probability of diversification. Yeah, we know that is a benefit of multinational company, that if the multinational company is located in different locations, different geographical regions, they can enjoy the diversification benefit. At the same time, they are facing a higher political risk, right? So when we estimate the risk factor, we have to consider these things as well. These are the very qualitative factors that we should incorporate into quantitative aspects and consider when we value the beta, right? Yeah, there are some barriers maybe to international diversification. When you are going to diversify your portfolio internationally, there may be some barriers, right? Yeah, if you can diversify your portfolio internationally, it will be beneficial to the shareholders, right? So but there are some barriers to diversify, because there may be some economic barriers. Some countries do not want other countries to come and establish. Yeah, cultural barriers may be there, right? Government barriers would be there due to the political problems between the countries, right? They might have barriers. Studies have shown that international index movements explain return on domestic companies after accounting for the domestic components of US indexes. This suggests that there is a significant benefit from the ability of multinational corporations to invest abroad. It is shown by the researchers that if you can go for the multinational business, right, they can enjoy a lot of benefits by diversifying your businesses in different nations, right? If you can locate your business in different countries, you can enjoy significant benefits. That means you can minimize your risk, right? Enjoying benefits through, maybe you are bearing higher risk and return is high, but that would be beneficial for the multinational company. there are different benefits. Maybe they will be able to enjoy the low raw materials, low labor cost would be very low. Right. What is the weighted average cost of capital for foreign projects? Right. This is how we calculate the cost of equity cost of capital, right? Cost of capital of a foreign project, right? KO is the weighted average cost of capital. 1 minus L time KE. What is that? What is L? L is the parent's debt ratio, right? Parent's debt ratio. It is given in the slide, right? Parent's debt ratio. That is true, right? Parent debt ratio 1 minus L. L is again, L times ID is debt ratio times cost of debt times again 1 minus T. Yeah, in order to take the tax shield, right? So KO is the net present value, the discount rate that we consider in NPV calculation, right? This is the weighted average cost of capital of the firm. 1 minus L times KE. L is the parent's debt ratio. So if a project of a multinational company shows a lower beta value, right, than the project of domestic firms, so what would be the WACC? If the project of multinational company, right, shows a low beta value than the domestic project, right? Low beta value means less risk. So what would be the WACC? Then WACC will also be declining, right? But there is a argument in the international finance that multinational companies should consider the unsystematic risk when they calculate the required rate of return, right? You understand? Some international companies, multinational companies consider that they should consider the unsystematic risk associated with the business, right? When they calculate the required, when they when they calculate the required rate of return, right? When they calculate the cost of capital, they consider only the systematic risk, right? They consider the systematic risk only they consider, right? They consider systematic risk and compare it with the required rate of return and take the decision, right? They consider the systematic risk, compare it with the required rate of return and take the decision. If that is the normal. situation, right? But some multinational companies argue that apart from the systematic risk, they have to consider the unsystematic risk as well if they are to compare with the required rate of return, because multinational companies face huge risk than other companies, right? If you only consider the systematic risk and compare it with the required rate of return and take the decision, that will not be showing the right or the accurate results for you to take the decision, right? That decision will be leading to a future value decrease of the firm. You have to consider systematic as well as that is an only argument. Normally what we do, we consider cost of capital and required rate of return and take the decision, right? Why we should consider this unsystematic risk, which is we assume in the CAPM model that unsystematic risk can be eliminated through diversification, right? But still it says that we should consider that unsystematic diversifiable risk as well. What is the reason? What would be the reason? Yeah, because it is located in again very uncertain environment. Uncertainty is very high. We can diversify, but we do not know that the project would be generating the right result. Therefore, we have to incorporate higher amount of cost on that when we take the decision, right? So that is the argument. That is only an argument, right? Right. When we calculate the WACC, like in the previous domestic firms, we have to consider the weights, right? Always we have to consider the market value, not the book value, right? Always we have to consider the market value. It is a must, not the book value, right? Because of the association of exchange rate to the cash flows, right? Exchange rate is always every single minute it is changing, right? If one variable is, if such a variable is there, so we always have to take the market value, not the book value. Today in our book, the exchange rate with the after conversion with the exchange rate, the figures will be showing that we have $10,000, which is equal to 143,000, right? Is it 143,000? Huh? It is 100, yeah. Let's say $1,000 into let's say $1,000 by 146 or 140, yeah, whatever the rate, it is 146,000, right? But after few minutes it will be dropping or increasing. We don't know that. Therefore, it is a must that we must consider the market value, right? Calculating WACC weights must be marginal, reflecting future debt structure. Again, we have to consider the debt structure of the capital structure of the firm. When we calculate the WACC, we have to decide the weights based on the capital structure of the firm. What is this? The weight must be marginal, reflecting future debt structure. What is the meaning of that? The weights that we are considering for the debt to equity ratio, right, should reflect the future target debt ratio, right? The weights that we consider for the evaluation of WACC should reflect the firm's target capital structure, right? Firm's target capital structure. Right, let's do one example. A firm with a corporate wide debt to equity ratio of 1 to 2 and after tax cost of debt of 7% and a cost of equity of 15% is interested in pursuing a foreign project. Right? The debt capacity of the project is the same as for the company as a whole, but its systematic risk is such that the required return on equity is estimated to be about 12%. The after-tax cost of debt is expected to remain 7%. What is the project's weighted average cost of capital? How does it compare with the parent's WACC? What is the project's weighted average cost of capital? That is very simple, right? Firm with corporate wide debt ratio of 1 to 2, debt to equity is 1 to 2. That means 1/3 is debt capital, 2/3 is equity capital. Okay, and after tax cost of debt is 7% and cost of equity capital is 15%. Is interested in pursuing a foreign project. The debt capacity of the project is the same as for the company as a whole, but systematic risk is such that required return on about 12%. The after tax debt is expected to remain at 7%. What is the project's weighted average cost of capital? What is WACC? KE 1 minus, what is the proportion? 33% is debt capital, 6% is equity capital, right? Let's say 67% is equity capital, right? 0.67 times what is KE, or else we can say 2/3 times 12%, right? Return on equity is estimated to be 12%. In the question it says okay, 12% plus we have what is the debt capital, the cost of debt capital, it is 7%. Cost of debt is, after tax cost of debt is 7%, so we don't have to multiply it from 1 minus t, right? 1.07% times 1/3. Okay, next question is, what is the answer for this? Huh? right? This is WACC. Next one is, how does it compare with the parents WACC? How does it compare with the parents WACC? What you can say about the parents WACC by looking at the projects WACC. Now we calculate the foreign projects WACC. Foreign projects WACC. What you can say about how does it compare with the parents WACC? It should be higher or lower or same. That is the question. It is not given whether it is higher, lower or same. How you would compare it with it? How? Based on what? Based on the risk, right? This reflects the risk the company faces. What is the answer you get here? No. What is the answer you get here? Yeah. 0.82. Should be more than that. 2/3 of point. Something happened, I don't know. Answer is point 1 something, right? That is 10%. 10%. Okay, not exactly 10%. Okay, shouldn't be exactly 10. Anyway, 10%. Let's say if the project's cost of capital is 10%, would you think that this is same as the parents' cost of capital? Parent will be risk will be increased. Why? Parent will be increased unsystematic risk. Parents' risk will be increasing. If this is lower than the parents' one, say for example, parents' cost of capital is 15%, right? This is only 10%. Then overall cost of capital of the parent would be decreasing. Average cost of capital of the parent would be decreasing because of this project, right? If this project is same risk as the parents' risk, right? Right? This would be okay, right? If this project is I mean less risk than the parent's risk, then parent value would be higher. Parent's cost of capital would be higher. This is less risk. Cost of capital would be less. The parent risk is more than cost of capital. Yeah. Right? Therefore, we have to compare the risk of the parent and the project's risk. Right, next one. If the project beta is 1.21, what is the unlevered beta? Assume marginal tax rate is 40 and DE is 1 over 2.
Unlevered beta means no depth.
Unlevered beta. What is this? This is an application of Hamada equation. Can you remember we discussed that equation? Hamada's equation, right? When you have levered beta using debt to equity ratio and marginal tax rate, we can convert into unlevered beta. When you have unlevered beta using same details, we can convert it to levered beta, right? Huh? What do you think? Unlevered beta should be higher or levered beta should be higher? Risk is more. Yeah, therefore unlevered beta should be lower. Okay. Right. Assume marginal tax rate is 40. Now part B. Right. What is the equation? Can you remember that? Unlevered beta equals levered beta divided by 1 plus 1 plus 1 minus t 1 minus t, right, times 1 plus 1 minus t times d over e. This is Hamada equation, right? D over e. Debt to equity ratio. So what is unlevered beta? Levered beta is 1.21 divided by 1 plus 1 minus yeah, that is 0.6. 1 plus 0.6 times 1 over 2. Right? So what is the answer? Unlevered beta is higher or lower? 0.93. Right? So you can see unlevered beta is lower. Right? So what is the answer? What is the conclusion here? If the firm faces no debt capital, if the firm has no debt capital, their beta, that is which systematic risk would also be lower, right?
Now here it is parent company.
That is only an argument, right? Based on the additional risk that the multinational companies would be facing, it is argued, it says actually not that is not an angle, that is actually what we have to do when we calculating the CAPM. We have to adjust that risk factor, what is called the systematic risk measured by beta. Beta should be adjusted considering all the risk factors associated with that investment, right? That means domestic firms systematic risk is different from international firms systematic risk, right? So the same thing, we have to do something like this. If we have a domestic firm, when we when we are going to calculate the cost of capital of the cost of capital of an international business, we can follow the same systematic risk for the international company, right, to calculate the cost of capital, because the systematic risk faced by the international business is totally different from the local company, domestic company. There are some other factors influencing on that, therefore we have to incorporate the right risk associated with that. Right, components of new investment. What is this? There are various sources of funds used by international business, the multinational companies, right? So all these various sources of funds we have to cost, whatever the, normally we know that companies use debt and equity capital, right? That when it comes to international business, that debt capital would be given by the parent company, or they might have given enough authority to borrow money from the local market by the parent company, right? So the equity capital, that would be that is subsidiaries retained earnings, not the equity of the parent company, right? Required subsidiary financing, that is the total. Required subsidiary financing is the total financing in the subsidiary that consists of dollars by parent, that is in other words parent company funds, right? So what is the cost of parent company funds? What should be the cost of parent company funds? Huh? No. These are the three different components of the investment, total investment, right? When we consider the P, the parent company funds, what would be the cost of that? Should that be equal to the parent company's cost of capital? Yeah, that's a very good way of thinking, right? This is an investment done by the parent company in a new project, right? So what would be the cost of that new project? Again, we have to consider about the risk. If that risk is equal to the parent company's risk, yes, we can consider the cost of capital of parent company, right? If that risk is different from the parent company's risk, or by undertaking that particular project, parent company has to face a higher risk or different risk, then we have to consider that as well when we count the cost of this investment. Understand? Okay.
It's a new investment,
Yeah, new investment done by the parent company, right? If the parent company but once they invest some money in the subsidiary, parent company expects some return, right? If they get the expected return from that investment, so we can consider that as the same cost of capital of as parent company, right? If it is different, we can't consider that as the parent company's cost of capital. Okay. What is subsidiaries retained earnings? Subsidiaries retained earnings. Yeah, from the retained earnings, what they have to do, they have to pay the taxes to the government, right? From the retained earnings of the subsidiary, foreign subsidiary, the government, they should pay some taxes on retained earnings, right? When we adjust with the taxes, we can consider as the cost of retained earnings, right? Because it has opportunity cost. What is the cost of retained earnings? I think in the next slide we discuss that. KE times 1 minus T. Cost of equity times 1 minus T. Right? If that is not retained with the company, that would have gone to the equity shareholders. Therefore, we consider cost of equity as the cost of retained earnings. Right? If that would have not been retained, that will have gone to the shareholders. So then we consider it as a cost of equity. Therefore, cost of retained earning is equal to cost of equity times 1 minus T for the foreign subsidiary, right? The last one, dollars from debtors. What is that? That is local currency borrowings by the subsidiary. If the parent company has given enough authority to the subsidiary, subsidiary can borrow money to run the business, right? If in that case, we have to consider the cost of particular borrowing or the interest as the cost of this source. Okay. Otherwise, we have to consider the borrowing rate of the parent company. But this source is specifically mentioned that local currency borrowing by the subsidiary, right? Dollars from debt means local currency borrowing by the subsidiary. So we have to compute each component separately. Parent company funds, that is the required rate equal to the marginal cost of capital, right? Required rate of return of the parent company. Retained earnings, that is a function of dividends, withholding taxes, tax deferral and the transfer costs. We to present all we use T, right? From the retained earnings, the companies have to pay the taxes, withholding taxes and other deferred taxes to the government. So we have to deduct that amount from the cost of equity. Local currency debt, that is the debt capital, the borrowings by the subsidiary after tax dollar cost of borrowing locally equals the sum of after tax interest plus the exchange gain or loss. Why is that? We have to consider the exchange rate gain or loss to the local currency borrowings, right? Because that have an impact on the weighted average cost of capital of the foreign subsidiary, right? Therefore, we have to consider the exchange rate gain, or if there is a devaluation of the currency, if there is an appreciation of the currency, we have to consider that. Right. This is the equation. By considering all those, this is the equation that we have to consider to calculate the WACC. Right? This equation has been expanded considering all the sources of finance. EJ, A is EJ divided by I, that is equity divided by total investment. Right? B is DF divided by I. Right? That is debt capital of the foreign subsidiary divided by total investment. K is the cost of equity, 1 minus T, parents after tax cost of debt. IF, expected after tax dollar cost of foreign debt. What is that?
Settlement. Settlement of debt.
Expected after tax dollar cost of foreign debt.
Yes.
Right? Foreign debt means what?
Foreign debt means whatever money borrowed by the.
Yeah, that cost we have to deduct. Right? KO is the one that we calculated before. Can you remember? Yeah. KE minus KS. What is that? Why do we deduct KE? We adjust there. We have adjusted what is KS, what is KE. Debt and equity. Or KS is the retained earnings. Cost on retained earnings. KS is the cost of retained earnings. In the KE is the cost of capital. So KS is the cost of retained earnings. Right? If you expand this equation, we can write this as KI, K1, right, equals KO right, plus 1 minus L, right, 1 minus L, you know what is 1 minus L, right, times KE prime. What is KE prime? Minus KE. KE prime minus KE, right? What is KE prime? KE prime, that is the cost of new investment minus cost of equity, right? This is the cost of cost of equity of the new investment times cost of equity, right? Why the KE prime is there? If the new investment changes the cost of equity, right? If the new investment changes the cost of equity, parents' risk would be changing, right? Therefore, we have to consider the difference between cost of equity of the previous project and the cost of equity of new project, right? minus A right, and the minus A K prime again, K prime KE prime, right? KE prime minus KE minus, there will be no, this part again will come here, right? This one will come there, this part as it is. Okay, don't have to write. Okay. So what does this imply? This cost of capital would be increasing from the new projects, higher risk, right? Then we deduct the balance, this one, this is KS, sorry, KE prime minus KS, this one.
There's no name for this one. No name.
For this equation? No, but this equation, I told you the story for this new one, right? This new equation becomes, we get when there is a new project, right? Cost of equity of the new project would be different from the cost of equity of the previous project, right? If that cost of equity is different from the previous project's cost of equity, apart from these factors, when we calculate the cost of capital of the project, we have to cost of capital of the parent company, right? We have to consider the additional risk associated with the additional cost of equity associated with the new project, right? So we'll do one example on this. That's why we add this part here. Right, a new foreign investment. This example is to explain that. Shall we take 5 minutes break, please?
Yes.